Do you want to boost your credit score by over 30 points in just one smart move? This one change could be the difference between a good credit score and a great credit score. And here's the secret. It's not paying your credit card by the due date, but paying your credit card by the statement closing date. But before we could go into exactly how to do that and how it works, we need to understand the 5 factors to a perfect credit score. I'm going to speed through them so you know exactly what to focus on, and we could get to the bonus hack at the end. First up is on-time payments, which is your payment history equaling 35% of your overall credit score, which basically means just pay your credit cards by the due date to avoid a late payment. Which reminds me, if you miss your due date, then technically it won't hurt your credit score because it doesn't report a late payment to the credit bureau unless you're 30 days or more late. However, you will incur some sort of late fee, so just try to avoid it the best you can. Next up, we have credit utilization, accounting for 30% of your overall score. Think of it this way. If you have a $10,000 limit and you're spending $5 grand, you're at a 50% utilization or 50% of your spending limit. Well, Nick, what's the goal? Keep it under 30%, better yet, 10%, 5%, or 0 if you can. This is the area we're going to talk about at the end of the video, where I'm going to share the bonus hack on how you can maximize this to skyrocket your score. So more on that in just a bit, but moving on. Third component is the average length of your credit history equaling 15% of your overall score. This is all about how old your accounts are, so whatever you do, avoid closing any accounts unless it's one of the worst credit cards. And if you must close the card, just remember, the credit history is going to stay and positively help you for up to 10 years on your report, but avoid closing one at any cost because it is truly the backbone of your credit report. The older you keep the card open, the more it's going to help this part of your credit score. Next up, we have credit mix equaling 10% of your overall score. This one is pretty easy to understand. It's just like having different types of accounts on your credit report. Credit cards, auto loans, mortgages, all seen as different types of accounts. Well, Nick, what do you mean by that? Basically, a credit card is what's called a revolving account, where an auto loan and a mortgage is more of an installment account that has a set monthly payment every single month, whereas a credit card, it's going to change based on your balance, and especially with what we talk about at the end. Lastly is hard inquiries equaling 10% of your overall score. Basically, when you apply for new credit and a lender checks your report, it puts a hard inquiry on your credit report that stays for up to 2 years. The good news is, after 2 years, once they fall off your report, the impact that they have on your report goes away. Now that you know these 5 parts, let's talk about the most important part, which is paying your bill by the statement closing date. Okay, remember how I mentioned that paying your bill by the due date doesn't really help because the credit card company reports your balance to the credit bureau, which ultimately controls your credit score by the statement closing date. So if you pay your balance down by the statement closing date, ultimately, you're going to increase your score, but let me give you an example. All right, and hopefully you could see this. So the big misconception people make is they pay the card by the due date, and then they spend here, which is the dates in between the due date and the statement closing date. For this example, the due date will be on September 3rd, and the closing date will be on September 6th. So basically, people are paying their bill, the minimum bill, or maybe even the full bill by the due date, which is correct, to avoid interest charges and to avoid a late payment fee. However, they start spending here again, and then once the statement closing date, if you remember from before, that's the date the credit bureau, the bank sends the information to the credit bureau, which gets stamped on your credit report. So if you spend on these days, the balance you have on this date, the Friday, the statement closing date, is the balance that gets sent to the report. So even though you may be paying it in full and using your card again, maybe to travel or go grocery shopping here, the credit bureau doesn't know you're paying it in full. They think the balance you have on this date is the balance that you typically carry because that's what you're showing them on the statement closing date. This is why people who may pay their card in full, they may say, Nick, I'm paying my card in full, but my credit score keeps dropping. What's going on? That's why I'm making this video. Let me take it a step further to show you how you can maximize this to see exactly what the credit bureaus are looking for to skyrocket your score. And we're gonna use this credit usage calculator. So here's what I recommend. You pay the card by the due date, you avoid interest charges, and you avoid late fee penalties on your credit card statement. You don't use the card here. you let it report a $0 balance or whatever you're choosing to pay for that month, and then you wait until the Saturday or a day or two after the statement closing date, whatever it is for you, to start using the card again. By doing this, you prevent a balance being shown on the credit report, which will help bring your score up. And now let me show you exactly how you can maximize this ratio to bring your score to its max potential. So continue watching. So hopefully you could see this. If not, we have a big problem. But basically, if you look at this chart, let's say our credit limit is $1,000 and we're spending $500 by the statement closing date. Effectively, that's a 50% credit utilization, which is not good. That will tank your score because it's showing the credit bureau you're using up a lot of your credit limit, and for whatever reason, again, you might be going through a financial distress or whatever the case may be, but the credit bureau sees this as irresponsible use and they're going to bring your score down. So here's the key. You want to keep the credit balance between 30% and 0%, preferably at 10, 5, maybe even 0% of your overall limit by the statement closing date. So on a $1,000 limit, that's only spending $100 or less by the statement closing date. So I'm not saying that you can't use your credit limit. You can use it as many times as you want throughout the month, but on that specific Friday, what we talked about before, the statement closing date, make sure it's paid down as much as you can. Which brings me to another point. So let's say that you get paid on this third, the Tuesday, which is your due date, you pay the card down and you have to use it again for grocery shopping on the Wednesday. Well, that's fine, because you could actually continue paying down the card in this interim period as long as it is paid down as much as you can by the statement closing date. Hopefully that helps. I don't want to confuse you by going further into detail, but that's the most simple way I could possibly explain it. The lower you have your utilization by that statement closing date, the better your credit score will be. If this video was helpful, consider subscribing. I upload a video 3 days a week to help you make more, save more, and raise your credit. Thank you so much for watching, and I'll see you next time.